So in this short video, we're going to be talking about subject to transactions. We're going to talk about what subject to is, how it works, how it benefits a seller and the investor, and why you need to know how to handle a subject to transaction. So let's first just describe what a subject to transaction is. Now, most importantly, this is not an assumption transaction. This is a transaction that we used to call a silent assumption because it's a valid transaction between a seller and a buyer, but the underlying lender does not come into play, nor does a new lender come into play for the mortgage. This is where the investor or the buyer is agreeing to make the monthly payments under the seller's mortgage. They are not taking the financial liability of that. That's the biggest difference between a subject to transaction and an assumption. Now, when you look at the flow of documents on a subject to transaction, the seller is conveying deed record title to the buyer, and we always suggest that the buyer provide the seller some type of a security instrument, typically a deed of trust, to protect their interests in the event that the buyer fails to comply with making the payments as they have agreed. So this creates really a moral obligation for the investor buyer to make the payments because they don't have a financial obligation between them and the mortgage company. Now, they do have risk that if they don't perform properly, the seller, vis-a-vis the deed of trust they're holding, could foreclose and take the house back. So the first question that always comes to the investor buyer's mind is does this really happen? Do sellers really allow you to take ownership of their property, usually their largest investment they've ever done, to take control of their credit through making payments under their mortgage? And the simple answer there is yes. And of course, there is a myriad of reasons why this happens. First and foremost, it's usually a financial situation. They're behind in payments. There potentially is imminent foreclosure, and they need out. The marketplace doesn't allow them traditional mechanisms in order to sell the property. Maybe they are upside down on value in some format. They don't have sufficient cash to bring to the table to close the deal. Maybe the house needs so much repairs that it won't pass appraisal standards, and usually it's a combination of all those items. Now, sellers are going to sell the property also because of other issues. Maybe they've been transferred and relocated and bought another house somewhere and they can't afford 2 payments. We see that often. Maybe they're going through financial difficulties, a divorce. Maybe there are medical issues that they need to move quickly, and traditional sale mechanisms simply don't work. And so this is truly a viable exit strategy on behalf of sellers. In addition, oftentimes selling a house traditionally or for cash, the seller may walk away with little to no money. But by using a creative technique such as subject to, maybe we as the investor buyer are able to give the seller more cash than they would realize through a traditional sales mechanism. So let's talk briefly about what are the benefits for the investor buying a home subject to. Well, first and foremost, it's much easier than going through a banking or a mortgage transaction, having to go in, present financial statements, qualify for the mortgage, and go through all the hoopla that mortgage companies and banks want you to do in order to get a loan for the property. Next, and probably most important, is we're able to take advantage of a 30-year mortgage. Not a 10-year or a 15-year bank loan, but a house that has a 30-year pay rate. It's really a commodity. We're able to get a lower interest rate in almost every instance, a lower payment rate that's out there. And oftentimes, there have been many, many years of payments made on this mortgage, meaning you're now paying more in principal than maybe you are in interest. And all this adds up so that as you're making payments toward that mortgage, you're actually gaining more and more equity through your principal pay down of the loan that's out there. Keep in mind also that these transactions are very cost effective. If you go to a mortgage company or a bank, you're going to pay 1, 2, 3 points for the loan. You're going to have various processing fees, document drafting fees, this fee, that fee, and of course, title insurance fees. Oftentimes with subject to transactions, these transactions close in a law office, not in a title company. Title insurance is not obtained, although title is checked to make sure things are clear and appropriate out there. And this saves the investor buyer, who usually pays the closing costs, a lot of money. Now, I want to make a point here on closing costs. Keep in mind, so often our sellers who may be behind in payments haven't made payments for 6 months, a year. Heck, I've seen them go out as long as 4 or 5 years. So there is a good possibility your seller has just been pocketing this money. Maybe they've been living on it, but it's the if you don't ask, don't get syndrome. I always like to ask the seller if they have the ability to pay part of the closing costs. Maybe they can pay all of them or part of them. And guys, if you don't ask, they're not going to offer it. Remember to always ask those questions to your seller. So guys, in addition to all those items, it helps the investor buyer oftentimes generate substantial cash flow on these transactions. Maybe you've had to put cash into the transaction. Maybe you borrowed money from a private lender to help offset that cost and expense. But oftentimes the cash flow helps you repay those dollars or get a very attractive return on your investment. And keep in mind, these transactions can close very quickly. Not in 20, 30, 45 days, but sometimes in as little as 7 to 10 days they can close. So if your seller is up against the wall and needs to be able to move quickly, these transactions give you that mechanism to accomplish that goal. So let's talk how the subject to transactions also really help sellers. You know, so often if sellers had traditional mechanisms to sell their home, to sell it quickly, to put cash in their pocket, you would think they would take that. Sometimes though, they simply don't do it for goodness knows what reasons. They think the white knight's gonna come riding in and save them somewhere along the way, and it just doesn't happen, and they dig their hole deeper and deeper. I've seen a lot of sellers who think they're going to get a loan modification. Take this big chunk of arrears on the back of the loan, maybe in a second lien type scenario, but then it doesn't come through and it's denied. And now they've lost many, many more months of payments along the way, and there's no way that they can get caught up. They're stuck. That's where the investor buyer gets a chance to come in and be that white knight in those scenarios. So oftentimes, subject to transactions truly are the saving grace for the homeowner. This gives them an exit strategy because before they call us as an investor, typically most sellers call realtors, and they already know that they have a problem. There's an issue out there why they can't sell. They're upside down, house repairs, the things we've discussed previously. And so we get the chance to show them how to make this work and how we can get them out of that tight situation where they are. It helps us come in, as I said, be that white knight to, in so many cases, stop that foreclosure that can negatively affect their credit for the next 10 years. It's truly an awesome feeling when you can help that seller overcome these issues and get out from under the burden they have. And you can just see it on their faces and how their bodies react when you close the transaction and they realize they're no longer going through that foreclosure. You can help these sellers with transactions because we can close quickly. It's very cost effective. Oftentimes, no realtors are involved at all. The closing costs are usually paid by the investor buyer. So all these things work to the benefit of the seller at the end of the day. So let's take just a moment and briefly discuss some of the risks that are incurred for both the seller and the buyer in a subject to transaction. And there's two primary issues that come to light. The first one is that the seller is still liable on the mortgage. They have conveyed their house to the investor buyer, but their name is still on the dotted line. The investor doesn't have that financial liability as we've discussed. And so they want to ensure that the buyer is going to make their payments going forward. Now, oftentimes they don't care, they just want out of the deal, and I get that. But that doesn't mean that we as the investor or the buyer should take heed to that any less. We should do everything in our power to make our payments on time, because that's part of the win-win of these transactions, because the seller gets to reestablish credit off of the investor buyer's good payment history that's out there. Now, the second glaring issue that comes to mind is, of course, the due on sale clause, which is in most mortgages. And this affects both the seller and the investor buyer in the same way. If there is a default in the payment, or if the mortgage company, the lender, finds out that the loan has been, not the loan, but the property has been sold in some format, they have the option to ask the seller, that's their borrower, to pay off the debt. Now, I think we all can agree that our sellers don't have the ability to pay off the debt. If they did, we never would have bought the property in the first place. And so, although it would affect them negatively because the foreclosure would go against them, if we as the investor buyer bought this property, we most likely have paid a lot of money out of pocket to bring the loan current. We've made a lot of interest payments along the way. We've made repairs to the property, and we're out of pocket typically a lot of money. It's either our cash or money we've borrowed, maybe from a private lender. And so the last thing we want to do is put our cash or our second lien lenders at risk in those scenarios. So we've got to be aware and cognizant of both of these issues that are out there. And this is why disclosure is so important in these transactions, both at the time of the contract, and I like to redisclose these transactions again at the time of sale so that everybody goes into these transactions with their eyes wide open. They understand what the risk factors are, how things can affect them, how they're protected, and the cherry on top here is how this really benefits the seller at the end of the day. If you found this video helpful and you want to take the next step in your real estate investment career, head over to our website at theownerfinancenetwork.com, where you'll find all types of free videos as well as training classes that will help educate you more in both buying houses subject to and selling homes using creative finance. In addition, take a moment and comment below on other videos you'd like to see us do for you in regards to the creative finance industry. So guys, please don't forget to like this video and subscribe to our YouTube channel for many more free videos just like this. See you guys next time.